There's a moment in October 1907 when the entire American financial system is 72 hours from total collapse. Banks are failing by the dozen. Riots are breaking out in the streets. The government is powerless. And one man, a 70-year-old banker, locks the doors of his library and tells the most powerful people in America that nobody leaves until he gets what he wants. His name is J.P. Morgan. And over the next 3 weeks, he will save the country from economic annihilation. But that's not the story you need to understand. The story you need to understand is what he demanded in return. Because Morgan didn't just stop a crisis. He engineered the legal framework that would give private bankers control over America's money supply forever. And if you think the Federal Reserve is a government institution, if you think central banking exists to protect you, you're about to learn how that myth was created in a single month of manufactured chaos. Subscribe to Finhistorian if you want to understand how financial power actually works. Because what happened in 1907 isn't ancient history, it's the blueprint. Let's start with what nobody tells you about the Panic of 1907. This wasn't a natural disaster. This wasn't bad luck. This was a controlled demolition executed by men who understood exactly what they were doing. And it begins with 3 bankers who got too greedy, too fast. Augustus Heinze, Otto Heinze, Charles Morse. These names mean nothing to you now, but in 1907, they controlled $115 million in banking assets. That's $4 billion in today's money, and they weren't careful. They weren't patient. They were gamblers, playing with other people's deposits. Here's what they did. Otto Heinze hatched a scheme to corner the market on United Copper Company stock. His brother Augustus owned the company. Speculators were shorting the stock, betting it would fall. Otto's plan was simple: buy up every share available. Force the short sellers to buy from him at whatever price he named. Classic corner. Except he miscalculated catastrophically. On October 14, 1907, Otto launched his buying spree using $8 million from his brother's banks. Depositor money that wasn't his. The first few hours looked brilliant. The stock shot from $39 to $60. Speculators panicked. They were trapped, but Otto thought there were only 50,000 shares in circulation. There were 150,000. The speculators easily covered their positions. By evening, the stock had crashed to $30. The next day, $10. Otto Heinze was ruined. His brother Augustus lost everything. 6 brokerage firms went bankrupt in a single day, and $8 million of depositors' money had evaporated. Now here's where it gets interesting, because the Heinze disaster should have been contained. One bad trade, one family ruined, but it wasn't contained. It was amplified deliberately, and the amplification came from an institution that was supposed to prevent panics, not cause them. The New York Clearing House, an association of the largest banks in America. On October 17th, they held an emergency meeting, and instead of stabilizing the situation, they demanded that Heinze and Morse exit banking immediately. Public humiliation, forced liquidation, maximum damage. Why? Because the clearinghouse bank saw an opportunity not to save the system, to consolidate it, to eliminate competition, and they were willing to burn down dozens of smaller banks to do it. October 21st, Charles Barney, president of the Knickerbocker Trust Company, appeals to the clearinghouse for support. Knickerbocker is the 3rd largest trust company in New York, $65 million in deposits, no direct involvement in the Heinze scheme. But Barney was friends with Morse, and in a panic, connections are enough. The clearinghouse refuses to help. Worse, they demand Barney resign immediately. No hearing, no investigation, just resign. Barney has no choice. He steps down that evening, and his resignation becomes a death sentence for his bank. Because here's what you need to understand about bank runs. They're not rational. They're psychological. When the president of a major bank resigns suddenly, depositors assume the worst, and assumptions become reality when everyone acts on them simultaneously. October 22nd, 10 a.m. A crowd forms outside Knickerbocker Trust, hundreds at first. Then thousands. People are screaming, shoving, trying to force their way inside. Women are fainting. Men are waving their bank books, demanding their money. Inside, controlled chaos. Tellers are paying out cash as fast as possible, stacks of bills melting away. By noon, they've paid out $8 million. By 3 p.m., the vault is empty. The doors close. The crowd outside turns into a mob. The next morning, Charles Barney is found dead. Gunshot to the head. Suicide. He was 47 years old, and his death sends a signal to every depositor in America. If a bank president killed himself, no bank is safe. The panic spreads like fire. Trust Company of America. Lincoln Trust, bank after bank faces runs. In 3 days, 25 banks close in New York alone. Across the country, over 100 fail. The stock market crashes. The Dow Jones falls 50% from its peak. Factories shut down. Workers are laid off by the thousands. And here's the critical detail. The U.S. government is powerless. Treasury Secretary George Cortelyou injects $25 million into the banking system. It disappears in a day. The government has no mechanism to stop a panic, no central bank, no lender of last resort, no tools. This is the moment J.P. Morgan has been waiting for. Not consciously, not as a conspiracy, but as an opportunity that men like Morgan recognize instinctively when it appears. The moment when the government is weak and private power can dictate terms. October 24th, Morgan summons the most powerful bankers in New York to his mansion. Not a request, a summons. And they come because they have no choice. If Morgan doesn't act, the entire system collapses, including their banks. Morgan is 70 years old. Massive build, red nose, fierce eyes, cigar permanently clenched in his jaw. He's the richest banker in America, and he hates speculators like Heinze and Morse, believes the market should punish recklessness, let weak banks fail. But Treasury Secretary Cortelyou convinces him otherwise. If the panic continues, even strong banks will fail. Even Morgan's banks. The contagion is total. Morgan listens, smokes, thinks, finally agrees. But here's what Morgan understands that nobody else in that room fully grasps. This crisis isn't a problem, it's leverage. The government is desperate, the banks are desperate, and desperate people accept terms they would never accept in normal times. That night, Morgan locks 40 of America's most powerful bankers in his library, literally locks the doors, and tells them nobody leaves until they agree to his solution. This isn't a library, it's a fortress. Mahogany walls, Tiffany stained glass, paintings by Rembrandt, first editions of the Gutenberg Bible, and tonight, it's a negotiating room where Morgan holds all the power. His plan is simple. The major banks will create a pool of $25 million. Morgan will contribute most of it. The money will be used to support healthy banks facing runs. But there's a condition. In return for support, banks must sell assets to Morgan at prices he determines. Crisis prices, pennies on the dollar. Some bankers protest. This is robbery. You're using the crisis to buy us out. Morgan doesn't raise his voice, doesn't need to. Under the circumstances, you have no choice. He's right. They don't. By 3 a.m., every banker has signed. Morgan owns the meeting, owns the solution, owns the banks. The next morning, Morgan calls a press conference, and in a calm, commanding voice, he makes a simple announcement. The leading banks have joined forces. We will provide liquidity to all healthy institutions. Yeah, the panic is groundless. America's banking system is stable. I personally guarantee it. The effect is instant. If the richest man in America says everything is fine, everything is fine. Depositors return money to banks. Lines dissolve. The stock market rebounds. In 72 hours, Morgan stops a panic that had destroyed the country for 3 weeks. Newspapers call him the savior of the nation. President Theodore Roosevelt sends a telegram of gratitude. Congress debates a gold medal. Morgan is a hero. But here's what the newspapers don't report, what Congress doesn't investigate, what the public doesn't see. During the crisis, Morgan and his allies bought assets worth over $100 million at fire sale prices. Tennessee Coal, Iron and Railroad Company, a major steel producer, purchased for $45 million, worth $100 million a year later. Bank after bank absorbed into Morgan's network, competitors eliminated, market share consolidated. Critics say Morgan used the crisis for personal enrichment. Supporters say he saved the economy. Both are true. But the real question isn't whether Morgan profited. The real question is what happened next. Because the panic of 1907 didn't end with Morgan's intervention. It ended with the creation of a system that would make Morgan's power permanent. Let me show you how. Because this is where the story stops being about one crisis and becomes about the architecture of American finance for the next century. The panic of 1907 left scars. Over 250 banks failed. More than 1 million people lost their savings. Unemployment tripled. GDP contracted 11%. Recovery took 2 years. But the political consequence was more important than the economic damage. The entire country witnessed one man prove more powerful than the U.S. government. When the Treasury was helpless, Morgan stopped the panic with a word. This was impressive, but also terrifying. Because the question nobody could avoid was simple. What happens next time if Morgan says no? A financial system that depends on the goodwill of one 70-year-old banker is fragile, unsustainable, and politically unacceptable. Congress had to act. The public demanded reform. And this is the moment when Morgan's true genius reveals itself. Because Morgan doesn't fight reform. He shapes it. He doesn't resist the creation of a central bank. He designs it, and he does it through a secret meeting that most Americans have never heard of, despite it being one of the most consequential gatherings in U.S. history. November 1910. 3 years after the panic, 7 men board a private rail car in New Jersey under fake names. They're told to come alone, tell no one, use first names only. The rail car takes them to Jekyll Island, Georgia. A private resort owned by Morgan and his associates. For 9 days, these 7 men design the structure of what will become the Federal Reserve System. Who are they? Senator Nelson Aldrich, chairman of the National Monetary Commission and father-in-law to John D. Rockefeller Jr. Henry Davison, senior partner at J.P. Morgan and Company. Frank Vanderlip, president of National City Bank, the largest bank in America. Paul Warburg, partner at Kuhn, Loeb and Company. Experts in European central banking. Benjamin Strong, head of Morgan's Bankers Trust. Piet Andrew, assistant secretary of the Treasury. And Charles Norton, president of First National Bank of New York. Notice anything? 6 of the 7 men represent the largest banks in America. Morgan's banks. Rockefeller's banks. The same banks that profited from the 1907 panic. And they're designing America's central banking system in secret because they know if the public discovered that bankers were writing the nation's monetary policy, there would be riots. What they create on Jekyll Island is brilliant political engineering. It doesn't look like the Bank of England or the European central banks Americans fear and distrust. It looks decentralized, democratic, public, the Federal Reserve System. Not a central bank, a system of 12 regional banks. Not controlled by Wall Street, but overseen by a board of governors appointed by the president. It looks like government control, but the structure ensures banker dominance. Here's how. The 12 regional Federal Reserve banks are privately owned by member banks. Those banks elect the boards of the regional feds. And the regional feds have enormous power, especially the Federal Reserve Bank of New York, which handles open market operations and international transactions. Who controls the New York Fed, the largest Wall Street banks, Morgan's banks? And who sits on the first board of the New York Fed when it's created in 1914? Benjamin Strong, Morgan's protege. He serves as president for 14 years. Every major decision flows through him. The Federal Reserve Act passes Congress in December 1913. Most representatives don't understand what they're voting for. The bill is 1,750 pages. It's introduced days before Christmas recess. It passes late at night. When many members are absent, President Woodrow Wilson signs it into law. And just like that, the system Morgan built in his library in 1907 becomes permanent. The government didn't create the Federal Reserve to protect the public from bankers. Bankers created the Federal Reserve to protect themselves from the public. Let me show you the mechanism. Because this isn't theory. This is how it works. Before the Federal Reserve, there was a limit to how much the government could borrow. Banks only had so much money to lend. If the government wanted to borrow more, it had to convince lenders the debt was sustainable. Market discipline existed. After the Federal Reserve, that limit disappeared. The government issues bonds. The Fed buys them with newly created money. Unlimited demand. The government never has to stop borrowing. It can roll over debt forever because the Fed will always buy it. And who profits? The banks that own the Federal Reserve System, because every dollar of government debt pays interest, and that interest flows from taxpayers to bondholders. The largest bondholders are banks, pension funds, and asset managers, all ultimately controlled by the same financial institutions that designed the system. This is the Morgan innovation, not stopping the 1907 panic. That was the advertisement. The innovation was using the panic to create a permanent mechanism for extracting wealth from the American public through government debt, and it's still running right now, today. The Federal Reserve's balance sheet is $7 trillion. That's $7 trillion in government bonds and mortgage-backed securities purchased with created money. The interest on those bonds is paid by taxpayers, and it flows to the financial institutions that own the debt. The 1907 panic killed 250 banks. But it birthed a system that makes bank failures nearly impossible for the largest institutions, because now, when banks fail, the Federal Reserve bails them out. 2008 financial crisis, $16 trillion in loans and guarantees. COVID pandemic, $4 trillion in quantitative easing. Every crisis, the same response: create money, buy assets, protect the banks. And every time the public is told this is necessary to prevent panic, to protect jobs, to save the economy. The same arguments Morgan made in 1907, and just like 1907, the banks that caused the crisis profit from the solution. Here's the pattern. Financial institutions take excessive risks. The risks blow up. The economy faces crisis. The Federal Reserve intervenes, creates money, buys assets, stabilizes the system. The institutions survive. The public pays through inflation and debt, and the cycle repeats. This isn't a bug. This is the design. The Federal Reserve wasn't created to prevent crises. It was created to ensure that when crises happen, the largest banks survive and the costs are socialized. Morgan understood this in 1907. He didn't need a formal central bank to execute the strategy. He did it personally, locked the bankers in his library, forced them to accept his terms, bought their assets at crisis prices, saved the system, and profited massively. But personal power dies with the person. Morgan died in 1913. The same year the Federal Reserve was created, but the system he pioneered became permanent, institutionalized, and vastly expanded. Today, the Federal Reserve controls the money supply of the largest economy on Earth. It sets interest rates for the global financial system. It can create unlimited dollars at will, and it operates with minimal oversight. The Board of Governors is appointed by the President, but once appointed, they're independent. Congress can't fire them. The public can't vote them out. They answer to nobody. And who actually runs the Federal Reserve? Look at the backgrounds of recent Fed chairs. To Jerome Powell, partner at Carlyle Group Private Equity; Janet Yellen, professor and government bureaucrat; Ben Bernanke, academic and advisor to Wall Street firms. None of them are hostile to banking interests. All of them come from the same financial ecosystem the Fed was designed to protect. This is Morgan's legacy. Not the buildings with his name, not the art collections, the system. A central bank that looks like a government institution but operates to protect private banking interests. And it's worked flawlessly for over a century. 3 weeks in October 1907. That's all it took. 3 weeks of manufactured panic. One banker locking doors and dictating terms. And the legal foundation for the modern financial system was set. The government would borrow forever. The Fed would buy the debt. The banks would collect the interest, and the public would pay. The panic of 1907 wasn't a crisis that needed solving. It was an opportunity that was seized. Morgan didn't save America. He bought it. And the Federal Reserve Act of 1913 was the receipt. So when you hear that the Federal Reserve is protecting the economy, remember 1907. Remember Morgan locking 40 bankers in his library. Remember the assets purchased at fire sale prices. Remember the system designed in secret on Jekyll Island. And remember that the same institutions that caused the panic wrote the laws to ensure they'd profit from every panic afterward. The 1907 crisis destroyed 250 banks. But it created something far more powerful, a system where the largest banks cannot fail, where government debt grows forever, where money can be created without limit, and where every crisis transfers wealth from the public to the financial institutions that designed the trap. Morgan died wealthy and respected in 1913. His bank, J.P. Morgan & Company, survives as J.P. Morgan Chase, one of the largest financial institutions in the world. The system he pioneered in 1907 is stronger than ever, and most Americans have no idea it exists. That's the real story of the 1907 panic. Not a crisis that was solved, a crisis that was used. And if you want to understand how financial power actually operates, how crises are manufactured and exploited, how systems are designed to extract wealth permanently, right, subscribe to FinHistorian. Because what happened in 1907 is an ancient history. It's the playbook. And it's running right now on a scale Morgan couldn't have imagined. 3 weeks, one banker, one library, and the architecture of American finance for the next century. That's what power looks like when you know how to use a crisis, and that's what you just witnessed.